The signs are unmistakable. Overgrown lawns, boarded windows, eviction notices taped to front doors. Across the United States, a silent wave is spreading as foreclosures rise once again. From the pandemic-era buying frenzy to today's high mortgage rates, the housing market has shifted with brutal speed. And now, some cities are seeing foreclosure numbers climb to levels not witnessed in more than a decade. In this video, we count down the top 10 U.S. cities with the most foreclosures in 2025. Cities where missed payments, job losses, and inflated home prices are pushing owners to the brink. Subscribe to Discover the Nation to stay informed about every housing trend, every market shift, and every warning sign unfolding across America in real time. Number 10. Memphis, Tennessee. Memphis has always been a city of grit and rhythm. Its soul runs deep from the blues on Beale Street to the heart of the Mississippi Delta. But in 2025, that same soul is being tested by a housing market unraveling faster than anyone expected. Foreclosure filings have surged more than 35% in just 1 year. Low-income neighborhoods such as Fraser, South Memphis, and parts of Orange Mound are seeing waves of bank-owned homes return to the market. Blocks once filled with families now sit half-empty, overgrown lawns and boarded windows marking the fallout of an overheated market. The causes are layered. Stagnant wages have left families vulnerable. Rising property insurance costs are eating into already thin budgets. Thousands of buyers who stretched too far during the pandemic boom are now falling behind on payments. Adjustable rate mortgages that seemed manageable in 2021 have reset to unaffordable levels in 2025, pushing homeowners to the edge. Investors who once flooded Memphis for cheap rental returns are quietly exiting. Vacancy rates are climbing and city code enforcement can barely keep up with the surge of abandoned homes. Even landlords are defaulting as rents stagnate and repair costs soar. Still, the heart of Memphis beats on. Downtown redevelopment continues. The music still plays. But behind the rhythm lies uncertainty. Families unsure whether to sell, stay, or surrender. This is not just another market dip. It is a warning about what happens when optimism outruns income. Subscribe to Discover the Nation for the real story behind America's next foreclosure wave. Memphis is not alone. It is one of many cities feeling the aftershocks of a boom built on borrowed time. Number 9. Cleveland, Ohio. Cleveland is a city built on endurance. It has seen prosperity decline and rebirth. Yet in 2025, it faces a familiar and painful challenge. The housing market, which once promised stability, is trembling again. Foreclosure rates have jumped 32% in just a year, marking the sharpest increase in Ohio. Neighborhoods east of downtown, like Glenville, Hoe, and Fairfax, are filled with vacant homes and boarded windows. Streets that once echoed with the sound of children now sit in uneasy silence. Investors who bought aggressively during the pandemic are walking away, unable to cover maintenance or find tenants in a softening rental market. City services, already stretched, struggle to keep up with rising blight and property abandonment. Cleveland's affordability once attracted working families and out-of-state buyers, but that promise has faded. Insurance premiums, property taxes, and energy bills have all risen faster than wages. For many, one unexpected medical bill or missed paycheck is all it takes to lose everything. Revitalization efforts are slowing. Projects in Midtown and Tremont have paused as financing dries up. Optimism that once filled Cleveland's downtown corridor is slipping. The Browns still rally the city. The Rock and Roll Hall of Fame still brings pride. Lake Erie still glimmers with potential. But the empty houses tell another story. Opportunities slipping through the cracks. Cleveland's reality today could soon echo through every Rust Belt city trying to rebuild faster than its economy can sustain. Number 8. Jacksonville, Florida. Jacksonville was celebrated as Florida's affordable frontier, a growing city with jobs, space, and sunshine. During the pandemic boom, it became a magnet for new residents. Developers raced to build. Investors poured in. Prices climbed to record highs. But in 2025, the growth that once felt unstoppable has reversed. Foreclosures have surged 40% in just 12 months, one of the largest jumps in the Southeast. Neighborhoods like Arlington West Side and South Side are dotted with abandoned properties and unkempt lawns. It's an eerie echo of 2008. Many homeowners now in trouble bought at the height of the pandemic with adjustable rate loans. As those rates reset, payments have doubled or even tripled. Insurance costs have become crushing. In parts of Duval County, homeowners are paying more than $6,000 a year for insurance alone. New flood maps and coastal risks have only worsened the strain. Builders who once had waiting lists are now offering price cuts, incentives, and closing credits just to move inventory. Buyers are hesitant, lenders are cautious, investors are retreating. Jacksonville's advantages, its beaches, ports, and military presence now feel like liabilities in a high-cost environment. Flood risk, insurance volatility, and rising maintenance expenses are forcing families into hard choices. Some are selling at losses, others are walking away. The St. Johns River still sparkles at sunset and downtown revitalization continues in hope of recovery. but optimism has turned to anxiety as residents wonder how deep the correction will go. Jacksonville isn't an outlier anymore, it's a sign of what happens when growth runs ahead of reality. Number 7. Las Vegas, Nevada. Las Vegas is a city built on ambition, glimmering lights and the thrill of risk, but in 2025, the gamble is faltering. Foreclosures have surged 45% from last year, the steepest rise since the Great Recession. The hardest hit areas aren't the luxury towers on the Strip, but the suburban sprawl beyond it, North Las Vegas, Henderson, and Summerlin. Streets that once symbolized new beginnings are lined with for sale signs and silent homes. During the pandemic, thousands rushed to buy, betting that migration and tourism would soar forever. Now mortgage rates have doubled, energy bills in the desert have climbed, and property taxes are up. For many families, the math no longer works. Tourism, Nevada's lifeblood, has cooled. Casino revenues look strong on paper, but job growth hasn't kept pace. Reduced hours and lost overtime are leaving workers behind on payments. Home builders are cutting prices and halting projects. Investors are liquidating. The rental market is softening as insecurity spreads. Yet at night, Las Vegas still glows with illusion. The skyline sparkles, the Strip hums, and tourists still pour in. But behind the lights lies a different story: overconfidence, debt, and families struggling in silence. Las Vegas has always mirrored the national economy. This time it may again be first to show how deep the downturn will go. Number 6. Detroit, Michigan. Detroit's story is one of grit and resilience. The city that built America's cars, powered by innovation and endurance. After years of struggle, hope returned: investment, downtown revival, and a belief that the worst had passed. Yet in 2025, that fragile comeback faces a test. Foreclosure activity has surged 38% since last year, spreading through East Side neighborhoods and the Southwest Corridor. Areas that had begun to show progress are losing ground as pressures mount. Property values that rose steadily since 2015 are slipping. The foundation of Detroit's recovery, working-class stability, is cracking. The auto industry, long the city's heartbeat, is faltering. Job cuts and production delays have left thousands uncertain. Inflation has pushed everyday costs to record highs. For many, a single missed paycheck can mean losing their home. Insurance and utility costs are climbing, stretching budgets beyond their limit. Vacant houses, symbols of Detroit's darkest years, are starting to reappear. Community organizations race to prevent another wave of blight, but resources are thin. The city's tax base, which had just started to recover, is thinning again. Residents who fought to stay are questioning whether they still can. Still, Detroit refuses to quit. The art scene thrives. Entrepreneurs open shops downtown. The skyline still glows with ambition, but progress built on fragile ground can crumble overnight. Detroit's struggle today is a blueprint for how old industrial America faces its next housing storm. Number 5. Phoenix, Arizona. Phoenix was the face of endless expansion. The Valley of the Sun boomed as homes sprouted across the desert faster than builders could finish them. Californians moved in by the thousand. Investors flooded the market. Prices soared, but in 2025, the heat has cooled. Foreclosure filings have jumped 50% in a single year, the steepest rise in the nation. Suburbs like Glendale, Goodyear, and Mesa are flooded with listings as homeowners fall behind. Properties that once sparked bidding wars now linger, marked by repeated price cuts. Water scarcity is one of Phoenix's biggest pressures. Droughts and restrictions on the Colorado River have slowed new construction. Investors are pulling back. Some residents are leaving, concerned about sustainability. Electricity and water bills have climbed, adding hundreds to monthly expenses for families already stretched. Many who bought at the peak are underwater as values slip. Builders are offering incentives and upgrades, but demand continues to wane. The rental market, once blazing hot, is cooling. Vacancy rates are climbing. Investors relying on short-term profits are quietly selling. Phoenix remains stunning: golden sunsets, mountain views, a glowing skyline. But beneath the beauty lies a fragile reality. The boom that defined Phoenix's rise is unwinding, and the correction may just be beginning. Number 4. San Bernardino, California. East of Los Angeles, San Bernardino once offered working families the affordable doorway to Southern California. In 2025, that dream is turning into a warning. Foreclosures are up more than 55% in a single year, the highest rate in the Inland Empire. Neighborhoods that once represented opportunity are lined with boarded windows and vacant homes. Unemployment remains among the highest in the state, and with few high-paying industries, many homeowners are slipping behind. Investors who rushed in during the pandemic, lured by cheaper prices and high rental returns, are retreating. Properties are flooding the market, driving prices and confidence even lower. San Bernardino's challenges run deeper than housing: underfunded infrastructure, stretched public services, and stalled job growth. For residents living paycheck to paycheck, even a small setback can spiral into foreclosure. Drive through the city and the story is clear. Highland Avenue, once bustling, stands quieter. Lawns are dry, Businesses shuttered, the sound of construction has faded, yet the people fight for their community. Neighborhood groups, churches and volunteers work tirelessly to prevent another collapse. San Bernardino's crisis is a window into California's hidden truth. Affordability without opportunity isn't sustainable. Number 3. Atlanta, Georgia. Atlanta once stood as the model for post-pandemic migration, wide suburbs, affordable housing, and a booming job market. Prices climbed, developers built relentlessly, communities appeared overnight. But in 2025, momentum has become risk. Foreclosures have surged more than 60% in the past year, one of the sharpest increases in the nation. Suburbs like Lithonia, College Park and Stone Mountain are feeling the squeeze. Buyers who entered during the low-rate frenzy are struggling as adjustable loans reset and property taxes rise. Insurance premiums have doubled in some neighborhoods, draining savings. Builders are slashing prices to offload inventory. Investors who once bought multiple homes are liquidating. The sprawl that fueled success has become a burden. Long commutes, high fuel costs, limited public infrastructure, turning desirable suburbs into financial traps for families living paycheck to paycheck. Downtown revitalization has slowed, corporate relocations have stalled, tech and logistics hiring is cooling. With fewer jobs and rising costs, homeowners are exposed. Banks are stepping up repossessions. Rows of vacant homes are appearing across the metro. Atlanta still radiates energy, a glowing skyline, unmatched food and culture, and people fighting for opportunity. But growth without balance leads to collapse. It's a warning for the entire Sunbelt. Number 2. Chicago, Illinois. Chicago is bold, resilient, and full of ambition. But in 2025, that strength is being tested as the housing market slips deeper into crisis. Foreclosure rates have surged 67% over the past year, a staggering jump that signals not just a slowdown, but a genuine emergency. The pain is concentrated on the south and west sides, in neighborhoods like Englewood, Austin, and Humboldt Park. Communities that have endured decades of struggle are now breaking under rising costs and shrinking opportunities. Property taxes, already among the highest in the nation, have increased again to cover city debts. Wages stagnate while utilities, food, and insurance climb. For many families, the math no longer works. Homes that once symbolized stability are slipping into foreclosure. Evictions are rising. Property tax delinquencies are piling up. The city's economy, still recovering from pandemic disruptions, has slowed in manufacturing and logistics. Job growth has stalled. Small businesses are closing at a steady pace. As more homes are lost, entire neighborhoods risk decline. Fewer taxpayers mean less revenue, which leads to more cuts, a cycle Chicago knows too well. Yet even in crisis, Chicago's identity endures. The skyline remains magnificent. Neighborhoods pulse with culture. People are determined. But economic pressure is overwhelming hope. What's happening in Chicago may be the roadmap for urban America tomorrow. Number 1. Houston, Texas. Houston has long symbolized Southern prosperity, affordable housing, rapid job growth, room for everyone to build a future. But in 2025, that story has taken a sharp turn. The city once praised for stability is now ground zero for the nation's foreclosure crisis. Filings in Houston have exploded, rising more than 70% year over year, the fastest increase of any U.S. metro. From Katy to Pasadena to Spring, families are losing homes at a pace not seen since the Great Recession. The reasons are many. Overbuilding during the pandemic created massive oversupply. Builders raced to meet demand, flooding the market with new homes. Now job instability in energy, manufacturing and construction has weakened the foundation. Thousands are underemployed or out of work. At the same time, homeowners' insurance has skyrocketed following new hurricane risk assessments. Premiums have doubled or tripled in some zip codes, making payments unbearable. Entire communities that once symbolized opportunity are now filled with empty homes. Builders are abandoning half-finished projects. Banks are tightening credit and raising standards, locking out first-time buyers. Long-time homeowners are trapped, unable to sell or refinance as property values slip. Flood risks and costly repairs compound the pain. Houston still shines with energy and diversity. The skyline impresses, the people remain determined. But beneath the surface, stress is spreading fast. These are the cities where homeownership dreams are collapsing, not gradually, but dramatically. Foreclosures are more than statistics. Each one tells a story of a family displaced, a neighborhood changed, a city forced to rethink its future. As we move into 2026, the fallout is far from over. Subscribe to Discover the Nation to stay ahead of every twist in America's housing story, because the next chapter could be closer than you think. And across Texas, the real estate giant of the South is showing cracks in 2025. Median home prices statewide have fallen about 3.2% year over year, now averaging around $331,000, more than $70,000 below the U.S. median. Austin leads the decline, at down 6.4%, followed by Dallas, at minus 4.1%, San Antonio, at minus 3.5%, and Houston at minus 2.8%. Inventory has surged 30.7%, with more than 132,000 active listings. Homes now take about 105 days to close, up sharply from last year. This slowdown marks a major shift from the 2020-22 surge, when low taxes, cheap land, and corporate relocations by giants like Tesla and Oracle drew hundreds of thousands of new residents. Listings vanished overnight, prices skyrocketed, but by 2024, supply doubled, erasing seller dominance. With mortgage rates hovering between 6.8% and 7.2%, affordability became the ceiling. Demand slowed sharply. The psychology flipped. In 2021, buyers feared missing out. In 2025, they fear overpaying. Bidding wars have disappeared. Sellers are covering closing costs, buying down rates and offering incentives. Yet experts say this isn't a crash. Texas didn't overbuild like in 2008, and population growth remains strong. What we're seeing is a recalibration, a repricing of risk. Affordability is the heart of the crisis. A $330,000 home at 3% interest cost about $1,400 a month in 2021. In 2025, at 7%, that same home costs more than $2,600 before insurance or taxes. Many middle-class buyers are priced out. Sellers either cut or wait months for offers. Inventory may be higher, but sales are down about 1.5% statewide. Insurance premiums add another layer of pressure. Across Texas, especially in Houston and along the Gulf, rates have jumped 20 to 40% as carriers react to billion-dollar storm losses and wildfire risks. For many buyers, insurance adds $200 to $300 to monthly payments, wiping out affordability gains. Lenders are requiring larger escrow reserves, delaying closings already taking more than 100 days. Insurers are pulling back coverage in flood-prone zones, and even minor FEMA map updates can freeze entire neighborhoods overnight. In this new climate, liquidity is drying up. Fewer deals close, and those that do take longer. The total number of listings has jumped to 132,993, up 30.7% year over year. Homes still sell, but more slowly, and only after price cuts or negotiation. Realtors call it a pause market. Transactions happen, but at a crawl. Sometimes the slowdown hits instantly. A Federal Reserve hint at delayed rate cuts can stall deals statewide within hours. Coastal insurance moratoriums after storm warnings can do the same. These micro-freezes stop the market for days, creating uneven momentum. Buyers are watching interest rate news like weather reports. As one realtor put it, "We're not waiting for prices to drop anymore. We're waiting for rates to breathe." Meanwhile, Texas's growth model is under strain. The state's no-income tax policy attracts residents, but limits funding for infrastructure and housing programs. Local governments face zoning backlogs, staffing shortages, and rising construction costs. Developers in Austin and Dallas report permit times doubling. Houston grapples with flood regulations and inspection bottlenecks. The result is a tangle of delays that reinforces the market's sluggish feel. But Texas isn't one story, it's several. Austin, hit hardest, is down 6.4% as tech layoffs and luxury overbuilding weigh on prices. Dallas-Fort Worth is mixed, some suburbs down 4%, others slightly up on corporate relocations. San Antonio fell about 3.5% as insurance and taxes erode its affordability edge. Houston remains relatively stable, supported by oil jobs, but pressured by insurance costs. Smaller cities like Waco, Tyler, and College Station are bucking the trend, posting modest growth as remote workers and retirees chase value. This uneven pattern defines 2025. Texas isn't collapsing, it's redistributing. Wealth and demand are shifting outward, away from overheated metros toward balanced mid-sized markets. The frenzy of 2021 has given way to a cautious equilibrium, where patience and negotiation rule. By late 2025, analysts expect prices to stay flat or dip slightly before rebounding in mid-2026, assuming rates ease. Texas's fundamentals, job creation, population growth, and a pro-business climate, remain intact. The scoreboard median price around $331,000, inventory up 30.7%, homes selling in roughly 105 days, and sales down just 1.5%. For buyers, this is a moment to prepare financing and be selective. For investors, it's a targeted buying window. For homeowners, it's a reminder the market didn't crash, it normalized. The Texas housing story of 2025 isn't destruction, it's discipline. The boom has cooled, the market is breathing again, and the state's vast landscape is finding a slower, steadier rhythm built to last. Subscribe to Discover the Nation for the data, the context, and the on-the-ground stories behind America's shifting housing market, so you can see the next turn before it arrives.